Friends, thank you for being here today. We stand at a precipice in the financial markets, a moment of convergence where historical patterns, industrial necessity, and monetary fragility are colliding to create a scenario that few are prepared for. If you hold silver, or if you hold gold and are considering the broader precious metals landscape, the analysis we are about to discuss is not merely a suggestion, it is a critical warning. Before we dive deep into the data, I want to do a quick pulse check of our community. Are you currently holding physical silver, or are you sitting on the sidelines waiting for a dip? Let me know in the comments below. I read through them, and I am curious to see how positioned you are right now. We are looking into the research and projections of Francis Hunt, a market analyst known for his deep technical scrutiny and his ability to strip away the noise of the daily news cycle to reveal the structural machinery driving asset prices. Hunt has issued a major alert regarding silver prices. This is not the standard silver to the moon rhetoric we often hear in the echo chambers of the internet. This is a calculated, data-driven assessment of a market that is fundamentally broken, suppressed, and on the verge of a violent correction. The premise we are exploring today suggests that the relationship between gold and silver, the ratio that has defined value for thousands of years, is about to collapse. And when that collapse occurs, silver will not stop at the psychological milestones of $50 or $100. We are looking at a projection of 4-digit silver prices. We're talking about $1,000, perhaps $2,000, in what Hunt refers to as traditional money terms. I have to pause here and ask you, what is your personal price target for silver in this cycle? Do you think a 4-digit price like $1,000 is actually realistic, or is that just wishful thinking? Drop your prediction in the comments. Let's see who gets it right. But why? Why now? And more importantly, why is the supply chain utterly incapable of preventing this price explosion? The answer lies in a single, terrifying statistic. Between 60% and 70% of the world's silver supply is a secondary product. It is a byproduct of mining other metals. If this fact does not concern you yet, it will by the time we finish this analysis. When you combine this inelastic supply with the emergence of solid-state battery technology, which could theoretically consume 100% of today's silver production, you are left with a zero-sum game. 0 silver for solar panels, 0 for electronics, 0 for investment. The supply shortage has already started. The data indicates we are past the point of no return. Yet most investors are operating under a veil of normalcy, unaware that the ground beneath the precious metals market has shifted irrevocably. Now, to truly grasp why this price explosion is inevitable, we need to examine the structural deficit and the byproduct anomaly. To understand the magnitude of the coming move, we must first dismantle the common misconceptions regarding silver supply. In a standard supply and demand economic model, when the price of a commodity rises, producers rush to create more of it, eventually balancing the market and stabilizing the price. This is Economics 101. However, the silver market does not function according to standard economic rules. It is plagued by a structural anomaly that Francis Hunt identifies as the primary driver for the coming crisis, the byproduct nature of silver mining. Let us examine the reality of extraction. The vast majority of the silver that enters the global market, roughly 2/3, is not dug out of the ground by silver miners. It is extracted by zinc miners, copper miners, lead miners, and gold miners. Consider the implications of this. If you are running a massive copper conglomerate, your profitability, your shareholders, and your operational logic are entirely dependent on the price of copper. You move tons of earth to extract copper. Occasionally, you find silver. To you, that silver is a bonus. It is a credit against your costs. It is not your primary business. Now, imagine a scenario where the price of silver doubles from 30 to 60. Does the copper miner care? Not particularly. Will the zinc miner double their production? Absolutely not. They cannot ramp up excavation solely to chase a secondary credit when their primary metal might be stable or falling. This means that the supply of silver is inelastic. It does not respond to price signals. The price of silver could skyrocket to $200 an ounce, and 70% of the global supply chain would be unable to increase output in any meaningful way. Be honest, were you aware of this byproduct problem before today? Type yes or no in the chat. It's a crucial factor that most mainstream analysts completely ignore. Furthermore, we must address the remaining 30%, the primary silver miners. One might assume they would rush to fill the void. But, as Hunt points out, you cannot simply flip a switch and launch a mining operation. It requires years of geological surveys, permitting, infrastructure development, and billions of dollars in capital expenditure, CAPEX. For decades, the price of silver has been suppressed. It has been kept artificially low, often below the cost of production for many potential sites. This financialization of the market has starved the industry of capital. Exploration has stalled. Development has been shelved. We have eaten into our seed corn. Hunt clarifies a chilling reality. Creating an excavation in the ground to extract silver consumes excessive energy relative to the price that's being offered. We have now reached the inevitable consequence of that neglect. We are entering a period where demand is about to go parabolic, and the supply side is structurally paralyzed. With the supply reality established, we must now examine the macro technicals and the phenomenon Francis Hunt describes as contagion. Francis Hunt is a technician. He reads the psychology of the market through the charts. When he looks at the gold to silver ratio, GSR, he does not see a simple line on a graph. He sees a coiled spring that has been compressed to the point of structural failure. The gold to silver ratio is the crucial figure that tells us how many ounces of silver it takes to purchase 1 ounce of gold. Throughout history, this ratio has maintained natural geologic ranges. In ancient Egypt, the ratio stood at roughly 8:1. During the Roman Empire and through much of modern history, it ranged between 10:1 and 15:1. Even accounting for geologic scarcity, a ratio of roughly 16.1 makes physical sense. However, in our modern era of financialization, where paper derivatives control price discovery rather than physical settlement, this ratio has been allowed to blow out. We recently witnessed the ratio touch 126. This is an incredibly high figure, implying that silver was undervalued to a historic, almost absurd degree. But Hunt notes that something has shifted. The ratio has dropped below the critical technical marker of 65. This is not just a fluctuation. In Hunt's analysis, this breakdown below 65 activated a massive macro reversal formation, specifically a head and shoulders structure that has been developing for years. This is the signal that the suppression is ending. Hunt describes the current state of the ratio as entering the contagion stage. What does this mean? Contagion, in this context, refers to a self-reinforcing cycle of panic buying and technical breakdown. It is when the momentum accelerates, technical indicators align across multiple timeframes, and prices begin moving faster than the consensus believes is possible. The technical structure suggests the ratio is crashing down toward 32, but Hunt projects it will go lower. He believes we will ultimately see the ratio drop into single-digit territory. Let us pause and do the math on what a single-digit gold-to-silver ratio implies. This is where the numbers become staggering. If we assume a conservative future for gold, let's say gold rises modestly to $3,000 per ounce, and the ratio collapses to 9, a return to ancient historical norms, simple arithmetic values, silver at 330 thrice per ounce. But Hunt argues that markets do not move in straight lines, nor do they stop at fair value. Markets, especially in the final stages of a secular bull run, are defined by overshoot. They react to decades of suppression by exploding in the opposite direction. You might expect a move to $300, Hunt observes, but wind up seeing $500 or possibly $2,000. This is the nature of the beast. When the dam breaks, the water does not gently flow to the new level, it crashes through. The suppression of the silver price has been the dam. The water is the global demand for monetary protection and industrial necessity. The contagion phase is the moment the concrete cracks. While the charts tell one part of the story, the industrial landscape reveals a demand shock that is nothing short of a pivot point for civilization. While the monetary arguments for silver are robust, the industrial case is perhaps even more compelling. We are undergoing a global transition in energy and technology that is entirely dependent on silver. Hunt refers to this as the transition to the iPad car and the iPad everything. We are moving toward a world of electrification, smart grids, and perpetual connectivity. The backbone of this new world is conductivity, and silver is the most conductive element known to man. There is no substitute. In high-performance electronics, you cannot swap copper for silver without sacrificing efficiency and increasing heat. In a world where efficiency is paramount, silver is the only option. But the real game changer, the black swan event for silver demand, is the solid-state battery. Current electric vehicle technology is limited by range and charging speed. The industry is desperately seeking a solution to range anxiety. Solid-state batteries are that solution. They promise ranges of 900 kilometers, over 500 miles, and the ability to recharge to 80% capacity in merely 8 minutes. This technology makes electric vehicles superior to internal combustion engines in almost every metric. However, these batteries possess one significant hurdle. They require enormous quantities of silver. Hunt presents a calculation that should keep every industrial manufacturer awake at night. If the automotive industry were to transition to these superior batteries, satisfying in just 20% of the market would require roughly 100% of the global silver production. Read that again. The entire world's silver output, every ounce dug up in Peru, Mexico, China, and Russia, would be consumed by the battery industry alone. This creates a zero-sum nightmare. If the car companies buy all the silver, what is left for the solar panel manufacturers? The solar industry is already a voracious consumer of silver. Every photovoltaic cell utilizes silver paste to conduct the electricity generated from sunlight. Governments around the world are mandating green energy transitions, subsidizing solar installations, and demanding net zero targets. They are legislating a demand for silver that the Earth cannot supply. This brings me to a critical question for you. Do you believe the green energy transition will be halted because of a silver shortage? Or will governments just print more money to buy the metal at any price? I'd love to hear your perspective on this. Then consider the electronics sector. Smartphones, laptops, servers, medical imaging equipment, guided missiles, satellites, all of them require silver. None of them work without it. Hunt observes, now the supply-demand equation has become completely shattered. We are moving into a world where silver demand could theoretically be 5 times, 10 times, or even 20 times the present production levels. In a free market, when demand exceeds supply by such a magnitude, the only mechanism that can resolve the imbalance is price. The price must rise high enough to destroy demand. It must rise high enough to force solar manufacturers to find alternatives, which don't exist yet, or to force electronics manufacturers to charge vastly more for their products. This is why Hunt is not forecasting a standard bull market. He is forecasting a supply shortage of historic magnitude. He is predicting a scenario where industrial giants are bidding directly against investors for physical metal, driving the price to levels that seem impossible today, but will appear obvious in hindsight. Now, a skeptic might ask about the stockpiles, which brings us to the illusion of above-ground inventory and financialization. This is the final piece of the suppression puzzle. For decades, we have been told that there is plenty of silver above ground. We look at the inventories of the COMEX or the LBMA, London Bullion Market Association, and we see millions of ounces listed. However, Francis Hunt challenges the validity of these inventories. He argues that we have been living in an era of hyper-financialization, where paper claims on silver have been treated as equivalent to the metal itself. Everything indicates that if you don't store it in a secure location within the boundaries of your own nation, you don't actually possess it, Hunt warns. Much of the reported inventory is leased, rehypothecated, or encumbered by multiple claims. It is the same ounce of silver sold to 5 different people. As long as everyone is content holding a paper receipt, the system functions. The price can be managed. The illusion of abundance is maintained. But we are seeing a shift. The smart money is demanding delivery. We are seeing a drain on physical vaults. When the industrial users, who need the metal to build actual missiles and batteries, come to the market, they cannot use a paper contract. They need the physical bar. Hunt argues that the inventory advantage is vanishing. The buffer that allowed bullion banks to manipulate the price is evaporating. When the physical inventory is depleted, the paper price becomes irrelevant. We will likely see a decoupling, where the spot price on the screen says one thing, but the actual cost to acquire physical metal is vastly higher. This is the moment the true price discovery begins. Understanding the fundamentals is only half the battle. The harder half is navigating the psychology of the parabolic move. Francis Hunt introduces us to the law of the parabola. This is a mathematical and psychological reality that governs speculative manias and revaluation events. He presents an exponential chart, a curve that stays flat for a long time and then goes vertical. The mathematics of this curve are counterintuitive. Hunt clarifies that in a true parabolic move, the majority of your profit materializes in the final 5% to 10% of the entire move. Let that concept sink in. Half of all the money you will make in this bull market will arrive in the last few weeks, or possibly the last few days of the movement. This is where the trap lies. This is where most investors, even the smart ones, will fail. Hunt warns, most people holding silver will observe the price reaching $100, $150, $200, and they're going to panic. Why panic? Not because they are losing money, but because they are making it. They will look at their account balances. They will see gains they have never seen before. Their friends will tell them they are crazy not to sell. The financial news, which ignored silver for years, will suddenly call it a bubble. They will feel an overwhelming urge to lock it in. They will sell at $200, and they will feel like geniuses. Then they will watch in absolute horror as silver skyrockets to $500, then $800, then $200. They will miss the stick of the hockey stick. They will miss the generational wealth event because they treated a structural revaluation like a standard trade. So, how does one navigate this? This brings us to the strategic implementation of your entry and your exit. Francis Hunt addresses the common fear. Is it too late? When silver hits $50, people will ask if they missed it. When it hits $80, they will despair. Hunt poses a straightforward question. If something is heading toward $2,000, does $82 appear like too much to spend? The problem is perspective. Investors look at the monthly chart, see a vertical line, and freeze. They're waiting for a pullback to $25 that will never come. I want you to think about this carefully. If silver hits $80 tomorrow, do you have the discipline to buy more, or will you freeze up? It's a tough call. Hunt's solution is the HVF, Hunt Volatility Funnel approach. He advises zooming in. He uses multiple time frames. While the monthly chart looks overextended, the daily or 4-hour chart will show pullbacks. Every single time silver pulls back, even by just $5 or $10 on the daily chart, it's an invitation to participate in the move, Hunt explains. He demonstrates this with his own trading account. He identifies micro pullbacks within the macro rally. These are the moments where volatility shakes out the weak hands. This is where the professional enters. He places stops at relative lows to protect capital, but he aggressively adds to winners. He views volatility not as a risk, but as an opportunity provider. The markets genuinely love you, Hunt states poetically. I demonstrate to people how to make the markets love them. Knowing when to buy is science, knowing when to sell is art. Hunt provides a robust framework for the exit, and importantly, it is not based on a dollar figure. If you set a target of selling at $500 and hyperinflation hits, $500 might buy you a loaf of bread. A fixed dollar target is dangerous in a currency crisis. Instead, Hunt advises watching the gold to silver ratio. The exit point for silver, Hunt clarifies, will depend upon the gold to silver ratio, not the absolute price. He is waiting for the ratio to collapse into single digits. When the ratio hits 15, 10, or 9, that is the signal. That is when silver has become historically overvalued relative to gold. That is when the smart money swaps their volatile silver back into stable gold, or into land, or into income-producing assets. Furthermore, Hunt does not advocate for a total exit all at once. He suggests a partial close. As the market rips higher, he secures profits, perhaps 50% of the position, to eliminate emotional pressure. This guaranteed profit lock allows the investor to let the remainder ride the parabola to its absolute peak without the fear of losing everything. Finally, we must confront the most sobering aspect of Francis Hunt's warning, the monetary horizon and the future of the dollar itself. We must conclude with this critical perspective. This analysis is not strictly about silver, it is about the dollar. When Hunt talks about 4-digit silver, he pauses. He lowers his voice. He admits the implications. At that stage, he states, I'm not certain what the dollar even means anymore. A world with $2,000 silver is not the world we live in today. It is a world where faith in fiat currency has likely evaporated. It is a world where the financialization of the economy has collapsed. I'm uncertain what form of currency will be in use at that time, whether it's still a dollar, a digital dollar, or something completely different. This statement hangs heavily over the entire thesis. The rise in silver price is effectively an inverted image of the fall of the currency. The profit you make is really just the preservation of purchasing power while those around you lose theirs. And Hunt suggests that the contagion we are seeing in the charts is the beginning of the end for the current monetary regime. The 75-year chart of silver, showing a squeeze within a squeeze since the 1950s, represents the accumulation of energy from decades of bad monetary policy. When it releases, it will mark a transition to a new system. Silver is the bridge across that transition. But to fully understand why this monetary reset is unavoidable, we must expand our view to the geopolitical accelerants and the terminal phase of the debt supercycle. There's a layer to this crisis that extends beyond mining mechanics and battery demand, a layer that explains why the smart money is moving with such urgency. We are witnessing the mathematical endgame of a 50-year experiment. Since 1971, when the link between gold and the dollar was severed, the global financial system has operated on a foundation of debt. Debt that is now metastasized into an unpayable burden. The United States government is currently paying more in interest on its debt than it spends on its entire defense budget. Let that reality settle in. The greatest military power in history is now subservient to its bond market. When a sovereign nation reaches this point, history offers only 2 exit ramps: default or debasement. A formal default is political suicide, which leaves debasement, the deliberate destruction of the currency's purchasing power to inflate away the debt, as the only viable policy option. This is the financial repression that Francis Hunt alludes to. In this environment, real assets like silver do not just rise, they become the only lifeboats in a sea of liquidity. The 4-digit silver price prediction is effectively a prediction of this debasement. It is the market realizing that the risk-free rate of treasury bonds is actually return-free risk when adjusted for real inflation. Do you trust the current system to protect your wealth over the next decade? Or are you looking for lifeboats? I'm genuinely curious to know your stance. Furthermore, we must address the tiny door problem facing institutional capital. For decades, silver has been ignored by pension funds, insurance giants, and sovereign wealth funds. It was too small, too volatile, too retail. But as the bond market fractures and equity valuations become stretched, these leviathans are looking for non-correlated assets. Consider this. The market capitalization of the entire silver sector, every mining stock and every ounce of investable silver, is smaller than the cash balance of a single tech giant like Apple or Microsoft. If the global pension system, which manages tens of trillions of dollars, decides to allocate just 0.5% of its portfolio to silver as a hedge against inflation, they cannot do it. The physical metal does not exist to satisfy that order. The moment institutional capital attempts to squeeze through this tiny door, the price function will fail. We will see a disconnect where the price gap's higher by $10 or $20 overnight, leaving those waiting for a dip completely stranded. This brings us to the geopolitical dimension, the accelerated trend of de-dollarization. The East is no longer content to trade real goods for Western paper promises. We are seeing a historic migration of physical bullion from West to East, specifically flowing into the vaults of China, India, and Russia. The Shanghai Gold Exchange is increasingly setting the tone for physical pricing, challenging the paper-dominated pricing of London and New York. This creates a dangerous arbitrage. The Western markets, specifically the COMEX, operate on a fractional reserve basis. For every ounce of physical silver in the registered vaults, there are hundreds of ounces of paper silver traded. This system works beautifully as long as investors are happy to settle in cash. But what happens when confidence erodes? What happens when a major player stands for delivery and the metal isn't there? We face the very real risk of a force majeure event, a declaration by the exchanges that they cannot fulfill their delivery obligations. In such a scenario, they will settle your contracts in cash. You will get your dollars back, perhaps at the closing price of the previous day, but you will not get the metal. The price of physical silver in the real world will decouple completely from the paper price. You might see silver trading at $500 on the street, while the screen price is frozen at $50. This is the unobtainium phase Hunt warns about, where price becomes secondary to availability. If you do not hold it in your hand or in a private allocated vault outside the banking system, you are merely an unsecured creditor to a bankrupt entity. Moreover, we must consider the strategic designation of silver. As we moved into an era of kinetic warfare and heightened geopolitical tension, silver's role in aerospace, satellites, and guidance systems makes it a matter of national security. It is not inconceivable that as shortages become acute, governments could classify silver as a strategic resource, restricting exports or even nationalizing mine output. We have already seen hints of this resource nationalism in Mexico and Peru. If the mines are nationalized or exports are banned to protect domestic industry, the global supply chain snaps instantly. This is why the wait-and-see approach is so perilous. The window to acquire physical silver at these suppressed valuations is closing not because of a standard market cycle, but because of a structural shift in how the world values sovereignty, debt, and scarce resources. So to squeeze within a squeeze, that Hunt identifies on the chart is the visual representation of this geopolitical pressure cooker. When the lid blows off, it will likely happen over a weekend, triggered by a sovereign debt crisis or a geopolitical shock, leaving the unprepared with paper currency that is rapidly seeking its intrinsic value of zero. Friends, as we wrap up, realize that Francis Hunt has provided us with more than just analysis. He has given us the gift of awareness. He has laid out the technical evidence of a macro reversal. He has exposed the supply-side fragility of byproduct mining. He has highlighted the insatiable demand of the coming green energy revolution. The train is departing the station. The contagion phase implies that momentum is accelerating. The question is no longer, will silver rise? The question is how high, and are you positioned? Most people will wait. They will wait for certainty. They will wait for the news to tell them it is safe. By the time they act, the ratio will have collapsed, and the wealth transfer will be over. Hunt reminds us that the market offers gifts. The pullbacks, the dips, the moments of doubt, these are gifts. They are opportunities to bend down and pick up value before the rest of the world wakes up. All you must do is bend down, open your eyes, and collect them. The choice is yours. You can stand on the platform and watch the train accelerate into the distance, carrying generational wealth with it. Or you can verify the data, understand the shortage, and take your seat. So, my final question to you is this. What is your move? Are you stacking more this week, or are you sitting on the sidelines? Let's get a discussion going below. Stay safe, stay informed, and stay positioned.